Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 30th of April. I'm Daniel Lam, your host for the podcast. Similar to the Bank of Japan meeting earlier this week, there has been two-sided debates about whether monetary policy should be going tighter in the latest FOMC. So the Fed held rates for a third consecutive meeting and signaled no urgency to cut. So the Fed left rates at 3.5 to 3.75% with an 8-4 vote in favor of the relatively unchanged statement, but that 8-4 vote is actually the biggest disparity since 1992. Now the dissents were two-sided, with one governor, Miran, favoring a 25 basis point cut, and three regional presidents voting against the easing bias in the statement. Still, a majority of the FOMC decided to keep that easing bias in the statement, meaning hikes were not considered for now. Also, it is very important to note that Fed Chair Powell announced he would be staying on the board as a governor until the legal challenges are resolved. So the meeting confirmed that, given energy-driven inflationary pressures, the Fed prefers to wait before cutting rates. Now, inflation was already sticky above target before the war in Iran, and inflationary pressures are spreading globally, although to a greater extent outside the US. Now, one important statement change was not so much discussed is the shift from inflation remains somewhat elevated in March to inflation is elevated, in part reflecting the recent increase in global energy prices in April. The dropping of the qualifier somewhat and making it clear that the war is not the only reason for elevated inflation suggests deeper concerns about inflationary dynamics. Risky assets move were relatively muted, but the movements in the dollar and US 10-year Treasury yield in the few sessions before the meeting already indicated this hawkish tone from the Fed, as well as, of course, reflecting the still elevated oil prices. So this also set up for some potential volatility ahead, particularly before the June FOMC meeting. Now, investors will be uncertain whether Walsh will try to shift the Fed back to a dovish track, accepting the hawkishness but try to mitigate it, or explicitly join what appears to be a majority in shifting to a more hawkish direction and risk Trump's rave. We believe the Fed is still going to be cutting rates in the second half of 2026 in order to support the okay but still weakish growth in the US. Hence, we would take volatility ahead as opportunities to be adding to our favored areas. For example, global semiconductor and AI infrastructure stocks, gold, long euro and yen against US dollar. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.